in this cycle, what we've been seeing is, um, energy companies want a buffer so that if they have an oil price problem, they can still pay their dividends. They use their cash for buybacks, but they also want to have a lot of opportunities. This gives them more opportunities for acquisitions to keep their reserves topped up. That's one thing they can do. I do think we're probably going to see, kind of a acquisition cycle where some of these cash-rich majors buy some of these lower-priced companies with bigger reserves, that they can add to their reserve pool. Um, we also see, if you're a energy company and you're facing all sorts of lack of clarity, right? So Fed tightening, recession risk, geopolitical concerns, political risk, like, random windfall taxes potentially being put on you due to public concerns around energy prices or climate or whatever.
Financial expert Lyn Alden dives deep into the strategies of energy companies amidst economic uncertainties. She highlights how these companies are strategically managing their finances, ensuring stability in the face of potential challenges. Alden sheds light on the acquisition cycle, where cash-rich majors are eyeing lower-priced companies to bolster their reserves. She delves into the complex world of gold investments, discussing its resilience and the potential challenges it might face. As the conversation unfolds, Alden examines historical events, comparing past and present political landscapes. The discussion touches on the delicate balance between political forces, judicial independence, and individual ownership rights. Let's dive into the rest of the video.
Um, you don't have a lot of incentive to like take the money you're earning and plow it right back into the ground. If you can earn 5% on your cash equivalents, um, they can just park it there and have this big kind of optionality fund. They can buy a company, they can protect themselves if oil goes down for a period of time more than they think. Um, it's basically a big flexibility pool. And what I point out with ExxonMobil and these other companies is that because they have very strong credit ratings and financial positions, they've been able to lock in long duration, low interest rate debt. So they can issue that, they were in a position to issue like 10-year bonds for like 2% yields. And so they locked in a lot of long duration debt. Now, as cash came in from that period of higher oil prices and still very profitable, they can put it into cash, and that's earning a higher yield than their bonds are. So energy companies are the new banks. Their cash assets yield higher than their bond liabilities on average. And so ExxonMobil probably has as much interest income as it has interest expense. And so there's limited downside for them having a cash buffer at this time. Basically, after they pay growing dividends, after they buy back some shares, they can hold that fund and then have optionality going forward. And it's a very strong position to be in. I view it somewhat similar in the sense that, I mean, today there's a 1% move to the upside. That can also easily be tied to a fall in real rates briefly, because there's a little bit of, when I say flight to safety, I mean it's a marginal day, right? It's not a spectacular day in terms of most prices of most assets, especially given the magnitude of what happened geopolitically, right? So it's actually been a pretty muted day in financial markets, all things considered. Um, in general, while the dollar is this strong, while official real rates are this high, that does put downward pressure on gold. Gold has held up pretty well for the past, year and a half, all things considered, because we do generally see marginal central bank buying of gold over treasuries. We do see people wanting to own some of it. I would fade kind of war headlines. If I was not bullish on gold, I wouldn't necessarily go out and buy gold just because of what happened this weekend. But I am structurally bullish on gold along with other assets, just in the sense that I think the sovereign debt problem is going to be an ongoing, unaddressed issue for the
Mm,
next 5, 10 plus years. I think it's just an ongoing thing. And then you always have the right tail opportunity that central banks can use gold to recapitalize themselves, right? And that's not really investable. Like it's kind of like the equivalent of a Nixon shock. Like there's things that can happen where you just wake up and gold's twice the price it was, and it's not something I would expect in say a 12-month period. But if I say, is this going to happen with the next 15 years? This is a decent shot, right? So it's like gold is a slice that I have in my assets, um, both in terms of a portfolio holding, but also it's one of the handful of assets that are bearer assets. So things like physical gold, things like self-custodial Bitcoin, these are assets that you can hold in your possession that no one can take away from you with a stroke of a pen.
Hmm.
If they want to get them from you, that's a lot more frictions to do it. They need more legal challenges or physical challenges. Bearer assets, I think, are worth owning in general in this environment. Well, if actually I would say no because you had very little no they didn't go door to door to get everyone's gold because
Hmm.
that would be a death wish, right? And so instead you had penalties, very few prosecutions. It was basically in a liquid market. And a lot of people just held on to their gold for 40 years. I mean, a lot of that gold was not turned in, and very few people face consequences for it. We also have to consider that happened. So the gold ban happened with a rare supermajority in U.S. Congress. So FDR and his party, that his party had 70% of seats in Congress,
Hmm.
right? They could do anything. They could pack the court. I mean, the things that they were restricted from doing were almost nothing, right? So that's different from being in a very political environment. I mean, a very polarized environment,
Right.
right? And so we're in this thing where you still have some degree of judicial independence. You have, difference of opinion between, what the president wants, what the Speaker of the House wants, what XYZ wants. We have a lot of disunity, which is bad in some ways, but it's also good if you're hoping that there's not like sweeping draconian intervention against things like owning, a benign yellow metal or owning a string of numbers representing a private key.
In this next discussion, Lyn Alden delves into the intricacies of financial strategies, shedding light on critical aspects of currency value and wealth preservation. Alden emphasizes the challenges faced by individuals, especially in economies prone to inflation and devaluation. She explains the dilution effects, highlighting how people's shares in the economic pie diminish over time, urging viewers to consider the broader perspective beyond conventional indicators like CPI or dollar pegs. Drawing historical parallels, she contrasts the slow debasement process of traditional coinage with the rapid dilution potential of modern fiat currencies. Alden advocates for investing in tangible assets like gold, dollars, or real estate as a safeguard against value erosion. Additionally, she delves into the complexities of unit of account, emphasizing the necessity of understanding the magnitude of dilution not just in savings, but also in negotiating ongoing income streams.
So there's a couple different things that they try to optimize for. One is saving, which is somewhat more manageable, and the other one is unit of account, which is harder. And so when it comes to saving, it's making sure people understand the dilution effects that are against them. And so that the way I explained it is, and people often just see the CPI, or they just see like a dollar peg, which is sometimes artificial.
Mm.
Um, Whereas looking at the actual broad money supply growth, I think gives you a bigger picture because if you're an Egyptian, for example, and you're not getting a 20% raise every year in local currency terms, you're getting diluted. Like your share of the pie is diminishing and you're getting diluted out of this monetary network. And that might be not be apparent in 1 year or 2 year or 3 years because you can do all sorts of pegs and things like that, but eventually pegs break, and eventually inflation surges, and you find yourselves diluted. And so back in kind of the pre-telecom era, when countries wanted to base their currency, it was a very slow process because if you held coinage, a king or ruler, the only way to really debase it was they had to, tax it in, remelt it, and then redeploy it in larger numbers in a diluted coin. And that's necessity, like a slow process. Whereas when you have either gold-backed currency or you have just fiat currency, you can just kind of print a lot of money overnight, and anyone holding that can get rapidly diluted. And so the first step is mainly to focus on real assets. Most people in these economies understand that. They understand that they have to own things like gold or dollars or real estate. The other hard part is just unit of account. And so to understand the magnitude with which they're being diluted, not just in terms of their savings, but that their ability to negotiate ongoing income streams.
Thank you for tuning in to this eye opening analysis. We hope you found this discussion insightful and thought-provoking. Remember, understanding the complexities of the financial landscape is crucial in making informed decisions about your investments. If you appreciated the insights shared in this video, don't forget to hit the like button, subscribe to our channel, and click on the notification bell so you never miss an update. Share your thoughts and questions in the comments below. We love hearing from our viewers. Stay informed, stay vigilant, and most importantly, stay ahead in your financial journey. Until next time, take care and invest wisely.